Don had asked me a question earlier via email. I didn't get a chance to put any slides together today, but Don was asking me about a bull put credit spread. And Don had said that, Mike, I've got a position where I'm in a bull put credit spread. We're going to sell an out of the money put, better. Sorry, we're going to sell an out of the money put here. So if I had a stock trading at $50, we might be selling a put, let's say, at 47, 46, and buying, let's say, a 44 strike put. We're going to receive a credit up front as long as the stock stays above both strike prices. Both puts expire, we keep the net credit. Now, let's just take a general search, and we're just going to go to the profit and loss chart of one of our examples there. We're going to use our basic search here, and let me clear out my drawings. Let's go ahead. Costco's a nice one, $397.50, $395. Let's just go to the profit and loss chart. With Costco at $410.37, we could potentially sell the July 30th $397.50 put for $1.30 and buy the $395 put for about $1. We get a 29-cent net credit on a risk of $2.50. Real risk is only $2.21. We keep that 29.30-cent net credit regardless of what happens to the position. So 2.5-point spread minus 29, got a true max risk of $2.21. This gives us about a 13.1% return as long as Costco stays above $397.50 to 30th July expiration. Now, the crux of the question that came in from Don was, Mike, I've got a bull put credit spread where the stock broke through both strike prices. So in this case, if he was in the Costco position, it was trading at $390 or $385. He mentioned that he hadn't had a chance to roll it yet. He hasn't seen an opportunity to roll the position, one of the 8 ways we might use to manage a bull put credit spread. And now, of course, he's nearing expiration. What do we do in this situation? Do you look to sell to close the long put and just take assignment and then maybe convert it into a married put or a collar position, buying a further out in time out of the money put, maybe selling a call against it? Or do you just let it get assigned and take the maximum loss for the trade? Let's take one step back. With many of the bull put discussions that we have very often here, is the fact that when I enter this bull put credit spread, I have stops and triggers in place. Sometimes those triggers can get violated, but there's opportunities to use adjustments in that case. What we typically look to do is we're going to look to close the position if the stock falls to within 1% of the short put strike price. We may simply just close the position and get out of it to not take further losses if the stock continues down in price. I want to try to keep my losses on the bull put credit spread to 50%. So I would close this position if the liquidation cost was essentially $1.39. I'm keeping this 29 cents regardless. So if my loss hits 110, my total liquidation loss is 110, half of the maximum risk I could see, I'm likely out of this position, even if I still have 5 days to go. Now, I may roll it down to lower strike prices and further out in time, which would lower the return because of the buyback cost. If I really think the stock's tanking when it hits this 1%, my sentiment has changed, I may just buy to close the short and leave the long open to have a long put position. Usually you got to have at least 10 days, 8 days remaining to expiration for that adjustment to work. But if the stock hits 1% of my short put strike price, that $397.50 was the strike price. So if the stock hit 343, 342, more like 343, yeah, I'm probably looking to close the position or make some adjustment on that trade. So that's called the 1% rule. I'd look to close it at that time. Or whenever I open a bull put credit spread, I'm looking for a positive SMA 20 and a positive MACD. If the stock falls below the SMA 20 while I'm in the trade, or the MACD goes from a positive crossover to a negative, where the signal line is now above the MACD line, I'm going to consider that the trends are reversing and I might want to get out of this position. Okay, but the 1% rule's good point to use right there. What I say, yeah, right about there, 397.50. So yeah, it's a 40, yeah, I'm sorry, 402. I don't know what I said before, but 399, 400 is where I'd look to potentially maybe close the position 1% of my 397.50 strike price, excuse me. Okay. Now, some things can happen where the stock's trading here at 402, 405. It's not at my 1% rule. And then suddenly there's just a gap down below both strike prices. Yes, that can happen. Now, if it gaps down into the middle, that's when I might use the pendulum adjustment. You can read more about that on our 8 ways to manage a bull put credit spread. Pendulum adjustment is where I'd swing when it goes, if it suddenly falls between the strike prices, I'm going to look to swing the long put. I'm going to sell to close it and buy a higher strike put. So with one move, I'm turning the bull put credit into a bear put debit as the stock is declining. And hopefully it can still be a profit. You have to work the math on that. And of course, this tool helps you do that as well. All right. But to answer Don's question, now that it's here and I'm nearing expiration, once you've hit a 50% loss, 60% loss on a spread that got against you, it's almost impossible to roll to any reasonable strike price in a reasonable time frame to get back to break even. What do I mean by that? This spread that matched my criteria was a 29-cent net credit on a 2.5-point spread for 14 days out in time. If I'm at 50 to 60% loss, I'm liquidating this position to roll it further out in time. And I'm paying, what? $1.10. I'm taking a loss. When I close this, even if I'm rolling, I'm taking a loss of $1.10, $1.20, $1.30. Which means what? I have to find a spread now that's 5 strikes, 7.5 strikes. Maybe I have to increase the strike difference on that position to make up the $1.10, $1.20, $1.30 loss I took on the position. Let's call it a $1.20 loss, which is what? Just wiped out 4 previous trades if I'm averaging around a 13% return on my bull put credit spreads. All right, so we're down 4 trades now. Can I find, in this case, a reasonable 2.5-point spread with a net credit of 120? No, it'd be right at the money or out of the money, which is very dangerous to do in these positions. How far out in time would I have to go to find a reasonable out of the money credit spread to make up the $1.20? What Don was asking about rolling out. I don't want just $1.20. I want $1.40. I want profit on this. But can I go out of the money and get a net credit of $1.20 on a 2.5 spread? No. I have to go unless I go really far out of time. I mean, 10 months, 8 months, 9 months. It doesn't work. I have to increase the strike prices, which means I'm increasing my risk. Let's go to a reasonable, let's just try September. Reasonable range out of the money with the puts. Okay, now we're at 5-point spreads here. So that one there at midpoint is actually pretty close, isn't it? It's about $1.20. It's $1.30 almost net credit here. But that's really close to at the money, isn't it? What do I mean by that? I'm in a position where I took a bull put credit spread thinking the stock was neutral to bullish, and now it's completely fell to this range. It's going against the direction that I thought. I don't want to be right at the money, right? The stock's at around 410. We're actually increasing the strike prices to get that $1.30 we need 60 days out. I'm going to be looking down here or here where we're at 50 cents, 60 cents. That doesn't make up the profit. It lowers the loss of 110 by maybe half, but unless I go right at the money, I'm not doing it. So what do I have to do? I have to go into this range where I'm comfortable, but increase the strike difference. That's a 20-point spread to get the $1.40, $1.50 that I want, net credit. Buying at 125, selling at 280. That's about $1.60, so maybe it's not that bad. But again, that's a 20-point spread. I started at a 2.5-point spread, $250 margin for one contract. Now I'm at 2,000, or 9 times the amount of risk if this stock continues to move down against us. That's dangerous. Okay? Could I go further? Let's go further out. Can we find a reasonable spread? Let's go to January, 6 months out in time. Remember, we're at 410. So let's call this 980, and we'll call that 11. That's about $1.20. That's not too bad on a 5-point spread. Let's check it out, 380 to 375. All right, so it's 125. I need a little bit more. I might have to go to a 10-point spread, but that's 6 months out in time. Why am I harping on that? Why am I harping on this idea of dangerous to increase the strike prices beyond what you have right now, and the dangers of trying to fix one spread that went fully against you, went below both strike prices in this case? And remember, we took in 30 cents. We're talking about a loss of 120 or 130 monetary loss, on this spread, which wiped out 4 previous trades if we're averaging 30 cents on a 2.5-point spread. Well, my spreads are typically 2 weeks out in time, okay, 11 to 14 days out in time. That's what I look at for my bull puts. I took that 120 loss. Oh, I'm sorry. If it went below both, I'm really sorry. If we went below both, as we're talking about in Don's situation, we're at a $220 loss. I'm not even there yet, right? I was basing it on the 50% loss, not the full loss that he might be taking at $221 per contract. But if I did take the half, and on average I was getting 30 cents on my bull put, 30 to 40 cents, or 13 to 16% return, if I just made 4 trades in the next cycle, I've made up that one loss if they all turn out profitable. It's not to say they're all going to turn out profitable. Why would I go 180 days out in time on the same stock to make up the loss of 120 or 50% on that one spread when I can keep going every 2 weeks and just need 3 or 4 successful trades to get back to break even? Not on the same stock. I'm saying abandon the stock. It didn't do what you wanted to. It was going the wrong direction. Something came out that caused that sentiment to change, Don. Don't try to just simply repair the bull put on the same stock because you started it. If you've hit your loss mark, or even if you've unfortunately hit the full loss on it because it went the wrong direction, you don't have to get back to break even with this particular stock and this particular trade. Follow your trading plan, find better stocks for the next cycle, and start gradually chipping away at that loss. Yes, I wiped out 4 trades if I took a 50% loss on that Costco position that we were talking about. But if I open another 2 or 3 spreads in my regular cycle for the next 11 days, and at the end of that 2-week expiration, open another 3 trades, and I'm right 85 to 90% of the time, I've made it back. I'm not 189 days away waiting for this thing to hopefully stay above 380 with fluctuations that could happen in the next 6 months that I don't know about. I'd rather just stick to the plan with new stocks that better match my criteria than to try to manage one. All of that being said, let me go back to square one here. We talked about how I'd normally try to close it. In this case, would never let it go, if possible, below both strike prices, but that can happen. We know that. The unexpected happens, it goes below both strike prices. I'm at expiration, it's below both strike prices, and am I going to allow the stock to be put to me and then maybe sell to close this long put, so I'm now long the shares of stock and convert it into a collar or a married put? Am I going to try to close it at the last minute and then roll 6 to 8 months out in time? No. If I could not roll prior to this point, where the stock maybe is at 385, it's below both my strike prices, I'm at the full loss for this position, I'm just going to go ahead, and I hate to say it, I'm going to take it. This did not do what I wanted. I don't know why I wouldn't be able to close it beforehand, because as we got into today, if it's below both strike prices, I probably could have closed this from near intrinsic there, near the maximum loss. I think Don did make a comment that the closing price, because of the bid and ask spread and the market makers in his case, was higher than the maximum loss, meaning they were asking him to close it for 260 or 270 on a 2.5-point spread, or 520 or 530 on a 5-point spread. Yeah, I'm not letting them get away with that. I'm leaving it open. It's below both strike prices. I'll let them do their thing where they buy shares of stock from me here and immediately sell them here. So I don't really get any margin hits or anything like that. I'm out for the full 100% loss, and I'm going to look to make that back following my standard trading plan of selling weekly or monthly bull put credits. That's the nature of credit spreads, unfortunately, and this is why we always say that you shouldn't be doing this more than 10 to 20% of your total portfolio value in that case. But that's what I would do, Don. Sorry to say it. I would just take the loss. I don't want to roll out to January. I don't want to roll 6 months out in time. I don't want to triple, double, or quadruple my risk, meaning increasing my strike difference from 2.5 points to 7.5 points or to 10 points to make up that $1.20, $1.30 I lost, and risk now taking 4 times or 5 times the maximum loss if that stock continues to go against me, Donald. That's what I would do in those situations when it's below both strike prices. When I just have that darness of luck, and out of nowhere, out of the blue, the stock just falls completely below both strike prices from out of nowhere, then yeah, I'm just looking to do it at that case. I'm just looking to take, I would take the full loss. And I agree with you. If this is what you were saying earlier, Don, if I'm at that place where it's below both strike prices and I'm trying to enter midpoint to buy to close my sold put and sell to close the long put, and they're giving me a loss that's higher than the maximum loss on the positions because they're both deep in the money, I'll just let them take it for the intrinsic and the full loss. I'm not going to take 108, 112, 115% loss. I'll cry in my beer or my wine later that night that I took the 100% loss, but I'm not going to let them get me to where it goes up to 120, 130% loss because of the prices in there. Okay. Pinot Noir. Okay, Don, you go Pinot Noir. I'm usually a Cabernet myself, or the one I really love recently is the Robert Mondavi, the bourbon barrel aged Cabernet. I think that one's really good. Okay. Oh, yeah. Okay. Charles points out. So I was mentioning these concepts of 8 ways to manage a bull put credit spread. And if you go to the option strategies on the webinars page here, there was a review we did recently. There's 8 ways to manage a profitable long call. Oh, sorry. Was it that long ago we last did that, Charles? I can't believe it. I thought I had one in here that was almost 8 ways to manage a bull put credit spread. That must have been on YouTube there. In any case, scrolling down here back to 2018, I know that's where it is. 8 ways to manage a bull put credit spread. Charles comments that therefore in this instant, you would do nothing as the management option. I guess I could call it do nothing in that situation. If I didn't get out when I hit my 1% rule, if I didn't get out before the spread hit 50% of its maximum loss, it got away from me and I'm at the full loss. But as Don mentioned, Charles, if I close it now, it's going to be more than the maximum. It's going to be 120 or 130% loss. Do nothing. Let them handle the exercise and assignment. Worry about it later with the Pinot Noir or with the Cabernet in that case.